The S&P 500 has gone up 6.41% in the past week. I'm assuming in the next couple weeks the market might go up a little bit more, maybe a lot more, but I'll just take a little bit more. That's what I'll assume. Just due to the fact that the economy's opening back up, I think that will help push prices of stocks up and probably bring back a little bit of GDP that was lost. But nonetheless, no matter what economy we have, there's always a bear in a bull case. So for the bear side, I'm the kind of person that I like to prepare for every eventuality. That includes things that are not even financially related to any financial assets. There's other eventualities that you can prepare for, but for the bear side, gold, silver, Bitcoin, you can use put options on the S&P 500. You can use put options on individual stocks or industries. So that's what I like to use for the bear side when I'm, evaluating things and trying to use more bearish tactics. But overall, I guess I tend to lean more for a bull kind of investing style. But there's pros and cons to both of those. The whole logic of Rome took centuries to build and decades to destroy. That always applies at any given moment to any economy. Any great superpower can be brought down to its knees eventually. That, historically speaking, has been the case. Then for my bull bets, I was a little disappointed this week. I've been looking more at Twitter, Markel, and I'm still actually looking at Berkshire. I know a lot of people are disappointed with Berkshire Hathaway, but I still like the company. Google, Amazon. The market went up, and basically all those stocks went up with them. I'm kind of picky about the price that I pay with stocks. So sometimes it's actually really hard for me to get into Google and Amazon and things of that nature. Facebook, those all tend to always be going up. But I'm going to try to do better and focus more on those companies than what I have in the past. I have 3 portfolios and 3 of them are missing tech. I mean, they has some tech in certain portfolios, but not as much as I probably should have. I've been really focusing on Twitter and Markel though lately, and I want to keep getting positions of those, adding more and more to it. I could always use options, call options on them, but I've just been sticking with just a simple buy and hold strategy for the most part and most of my portfolios. Twitter is still growing at 20%, somewhere in that ballpark, and I don't see that changing anytime soon. We'll see how it evolves over time. Every company has to evolve eventually and even diversify. And it will depend if it, works out or not. You think of Amazon. Amazon started off with just a book company, an online bookstore, then it evolved into a sell everything kind of store. It has Twitch, Washington Post. Well, I guess Amazon doesn't own the Washington Post, but Jeff Bezos over time has evolved his business ventures. Jeff Bezos Limited Liability Company, the Nash Holdings, they're the one that own the Washington Post, but either way, the guy's a business dude, and that's one situation and person that had to evolve over time to keep making the profit that he has been making and to remain relevant in the markets. That's just one example of a company that had to, over time, readjust and diversify and evolve. A pretty obvious example would be Berkshire Hathaway, right? That's a company that's just naturally a diversified type company, and it's been that way for years, for basically the whole entire time that he's invested in Berkshire Hathaway. It's been always a diversified business. Markel is another example too. And that's why I like those kind of companies, Markel and Berkshire, because it almost, to me at least, I can imagine in my brain that these kind of companies can keep diversifying and exiting and weaving in and out of markets to find out which markets offer the best growth. Not only growth, but safety at the same time. You can have growth but be doing illegal stuff or hurting the environment. So having that capability of being able to weave in and out of markets is kind of a nice thing. Sometimes when companies latch onto one market, it's a double-edged sword when they do that, but sometimes what happens is they just die with the industry. Whereas something like Berkshire and Markel, they can always, let's say insurance starts to over time become way less profitable. Let's say due to autonomous vehicles. Although I still think they can remain profitable even with autonomous vehicles because there's still the weather and vandalism. Now, with that being said, let's just say that it takes away 50% of their profitability with Geico. Now, Markel is different because it's specialty insurance, so it insures something like an antique car, but Geico would be hit harder than Markel. But let's say it's 50%. All Geico and Berkshire would have to do is just take the money and just invest somewhere else. Matter of fact, Berkshire could invest in the technology that is hurting Geico to become profitable in that manner. I guess we will find out what the next 2 days have to offer us. I'm really hoping that Twitter and Markel go down. We really like to invest more in Twitter. I want that to be a huge position. Twitter has the benefit of being a tech stock, but it's not trendy yet. Those are one of my favorite kind of tech stocks. A tech stock that is profitable, that is not trendy. Tech industry tends to have more trendy stocks than any other industry. So it's really nice to find a stock in that industry that is not trendy at this given moment. And then once it becomes trendy, I can either sell it or just hold on to it and then move on somewhere else in some other industry or even in the tech industry, move on to a different company and find something that's not trendy.